Welcome back to the channel, Crypto Trend Trader, and today we're going to be taking a long-term look at the DXY dollar index. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so here we have the DXY dollar index. First off, let's talk about why this is so important. Obviously, the buying power of currency is important. But when you start to add the different levels of it and say, okay, not only is the buying power of your currency relative to the goods and services you want to purchase important, but also relative to other currencies. So in this case, the DXY is the dollar indexed against various other currencies. So it is the euro, 57%, followed by the Japanese yen at 13%, and then the British pound at 12%. And then from there, we have Canadian dollar at 9%, Swedish krona at 4%, and then the Swiss franc at 3%. So that being said, when we look at the DXY index, we see not the strength of the dollar compared to goods and services, we see the strength of the dollar compared to other currencies. And this is most relevant when you're looking for places to invest your money or purchasing for potential imports, exports, etc. So if you have a strong currency, compared to people you would potentially purchase from, you get more for your dollars. If you have a weak currency compared to people that you purchase from, you're going to get less from your dollars, but they're going to get more from your dollars. So that means that your imports will likely go up as people are more able to afford those goods and services. They're more competitive on the global scope, as where when your currency is extremely strong, you get a lot of other people's goods and services, but your imports themselves are less likely to be purchased because of the additional multiplier from the strength of the currency itself. So that being said, the relative strength of the dollar is very important, and that is what the DXY is all about. So going from there, now that we understand essentially what it is and why it's important, the real question is, what do we see when we look at this chart? So this is the DXY monthly chart right here, and we can see basically going back to the 1980s. It does go back a little further after that. We have a previous high back here in 69, but this is obviously the main area that everyone focuses on, and this is the macro all-time high of the dollar. This was in 1985, obviously correlated with the massive amounts of inflation and Fed tightening of Paul Volcker, the whole, the myth, the man, the legend. So at one point in time, the DXY in this index reached 165. Now keep in mind also, as we go back to longer periods in time, that the index was not always the same. And then obviously certain currencies were not around. Like for instance, the euro has limited life cycle. So that being said, we reached 165 back here in 1985, after which we fell abruptly over the next 7 years. From 1985 to 1992, we put in a low at 78. So essentially, from the peak up here, which was obviously an anomaly, to the trough, the dollar fell in strength about 52%. But in all actuality, it essentially returned to roughly the same place that it was at before the massive pump. So reversion to the mean, obviously very important. So what we're going to do is we're going to start with a fib retracement. So we're going to go from the all-time high right here, and then we're going to go down. Initially, we would think, okay, we'll go to the low right there and see where that's at. And we don't see necessarily the strongest level of correlation. But now in hindsight, obviously, we're able to look back and say, oh, actually, if we go all the way to the macro high to the macro low, then we look for levels of correlation. It looks much more clean. Obviously, we have the peak here, and then we clearly find support around the 236. We push through it quite a few times, and then we push all the way back up to the 618. So the most common retrace on the macro. And then we push all the way down, put in that new low. So now we have a swing. So only in hindsight can we look back and see how important these fibs were along the way, telling us, okay, that probably is the macro low. Obviously now in hindsight again, since we ran up after that, we know that once again. So very key level was the 618, and that's why returning to the 382 is very important, and then getting to the 0.5 is very important, and then obviously potentially retesting the previous high is very important as well. So we're just off the 618 before we saw that recent weakness and sold off. So then next we want to use the swing from that 618, and then we're just going to do the exact same thing. We're just going to put this one here in yellow. So now we have a second level on this chart that we can look at. And again, from the high right here, that previous 618 swing high, to that same low here, we can see clear areas of interest around the 236, the 382, the 0.5, the 618. So we see the dollar is trading very, very technically. The 786, and then finally a perfect touch of the 886. So from the macro high on the way down, we basically hit the 618 on the back test and then put in the macro low. And then on the way back up, we essentially hit the 886, which is almost a full retracement of that previous wave. So the real question is, okay, do we top out and we're going to go back down here and put in a lower low or maybe a higher low, or are we going to recharge and then move up here and put in a new high? So obviously we don't know that in real time, but we can start to make some deductions based on how the chart looks and what's taking place. So here on the macro, we have a high, we have a lower high, and then potentially a third high, which is again lower than the previous two. And we obviously have a low and then a lower low. So the real trend on the DXY is down. And this has nothing to do with, what you hear people talking about with your, the dollar is losing all of its value, etc. All fiat currencies are designed for that purpose specifically because governments want the power to essentially not have to tax to spend. So if you want to and spend, that's fine. You take the money from people and then you spend that money. But if you want to run deficits consistently, obviously you're not taxing enough. So there has to be some other way that you can pay for those deficits, and they pay for it through inflation tax, which is essentially just creating more currency, devaluing your dollars or your work hours. So that being said, we would expect the dollar relative to goods to always trend towards zero. If that wasn't the goal, then we would obviously back it by something physical. So that's regardless. This is the dollar compared to other currencies. And what we see is from that high to the lower high, we then broke through that trend line in 2015, and then we actually back tested it in 2018. From that point on, we have essentially just put in a series of lower highs and lower lows. So if we just extend out this channel right here, we see there was a little anomaly push right here. It looked like we had broken down from it. You could go by wicks or you could go by closes, however you want to do it. In this case, we're just going to go by closes. We see some very, very clear correlation here. So we break out of the downtrend and then we start forming an uptrend, and we see very clear touches on the top of the trend, very clear touches on the bottom of the trend. And then of course, when we reach the top of that channel, we reach 886. That's a lot of confluence and seems like a very likely area that we would at least temporarily top out. So the important thing to note here is the DXY, or the dollar compared to these other currencies, has been weakening for a long, long time. And now here it has broken out of that downtrend and is forming an uptrend, a series of lower lows and higher lows and higher highs as well. So the key area that we're watching for, the most important thing is, at some point in time, do we take out the previous lower high? Because if we take out the previous lower high, then we have to start looking at the all-time high as a potential next resistance target. So we're at some clear resistance levels. We're very close to the previous high and have already confirmed a descending channel breakdown. And now, depending on what you're looking at next, there's a lot of different ways we can go from here. So I'm going to go ahead and just fade out some of this stuff so it's not quite as bright, and then we can focus on some other things as well. So obviously the beauty of technical analysis is being able to adapt in real time to whatever changes on the charts or what you're seeing. Sometimes you're going to use swings that end up not being relevant in the long run. Sometimes they're going to stay relevant for a long period of time, and it's important to pay attention to. Overall trend. We see here, obviously, we have the TJD Master on the chart here, which uses moving averages to determine trend. And we know when both moving averages are blue, we're in a bull trend. When both moving averages are red and pink, we're in a bear trend. So here we have a max out. Obviously, we're in a bull trend, and the bull trend ends around 1985 when all of the craziness takes place with inflation. Since then, we have a bear trend that lasts until 2000. We attempt to flip back blue right here. We actually do for a second, flip the 200 simple and 200 exponential blue, but then actually the 200 simple rolls back over, it fails. We never actually go into an uptrend right here. And then we go to a new low after that. So we're still clearly in a downtrend. And then here we break above the 200 exponential, break above the 200 simple, and we see them start to flip blue. But here, for the first time on this chart since 1985, we actually confirm into a bull trend in 2020. Right around January of 2020, the 200 simple flips back blue. We get a back test. We put in another in a series of higher lows. And then after that, it's off to the races. And now we are very, very clearly in a bull trend. So anyone that is betting on the dollar going to zero or weakening or crashing or anything like that is basically fighting technical analysis that goes back 40 plus years. So we've been in a downtrend for a long, long time, and it's very easy to just be bearish on the dollar or the DXY. Now we're very clearly in an uptrend, and people are still being very bearish on the DXY. But that is not what the technicals are showing us. Now, could this have topped out? We break down here, we lose the previous highs, it rolls over, we retest the 200s, we come back down here, we eventually break from the 200s, and then next thing you know, we're threatening all-time lows, and this is no longer in an uptrend? Of course, trends can fail on a regular basis. But the truth is, as long as momentum is in the favor of DXY, which it is, as long as the trend is in the favor of DXY, which it is, there's a lot of bots, algos, market makers, whales, central banks, countries, whatever, that are going to be using this trend following strategy to say, hey, the DXY is actually very strong. So could this just be part of the greater scheme of things? Before the dollar loses its world reserve currency status, it essentially has to have a liquidity spike, basically saying that before the dollar can go to zero, everybody has to close out all their shorts on the dollar. And essentially what the shorts are is not necessarily people specifically shorting the dollar, but essentially having dollar denominated debt that is not in fact the currency that your earnings are in. So let's say, for instance, I live in China. My revenue is coming from sales in China. If I take out debt in dollars, but my revenue is in Chinese yuan, essentially what I'm doing is saying, hey, the dollar has been in a downtrend for a long time. I would rather have my debt denominated in a depreciating currency. Therefore, when I pay off that debt, I still owe the same amount of dollars for that debt, but the dollars are worth less because of, essentially the loss of value relative. So the only problem with that strategy is when you have this long-term trend going down for 40 years where the dollar is weakening, you get a lot of emerging markets and other countries getting dollar denominated debt, not necessarily from the United States, but when they borrow that debt inside their country or from creditors, they choose to borrow that debt denominated in dollars because they expect in the future dollars will be worth less relative to their currency, which their revenue is generated in. Therefore, they will pay back the same amount of dollars, but they have less value. And that is essentially what the inflation is doing right now. Inflation is essentially eroding away the purchasing power, but it's also eroding away the debt. Because if the purchasing power of the dollar is down, well, if 100 years ago you used to be able to buy a car for $100, and then in the future, 100 years, you can buy a loaf of bread for $100, well, the guy who borrows $100 and buys a car with it and then pays for it with equivalents of a loaf of bread in the future made out really good on that trade. But the opposite of that trade can happen as well. And that's what happens when something that's been in a downtrend for 30 or 40 years flips into an uptrend. Everyone is expecting that to continue depreciating relative to their income. However, now the flip has happened. So instead of making that payment with $100, you now have to convert, say it's a 1-to-1 conversion ratio between your dollars and your euros. And then suddenly the dollar surges and becomes much more valuable in comparison to your euros. Your income is in euros, your debt is in dollars. So now when you take that 100 euros, convert it to dollars, and go pay your $100 payment, you actually need to convert 110 euros because it's getting weaker relative to the dollar. And if maybe it doubles again or something like that, then maybe you have to convert 200 euros to get $100. So you can see how the actual payment stays the same, but the amount of income or currency that you need to make that payment can go up. So the same way that it was beneficial to borrow in dollars and then pay back that loan using your own currency converted back into dollars, that is now the opposite. So anybody with dollar denominated debt is potentially in a scenario where they're short the dollar as the dollar is ripping to the upside. So anybody that's been paying attention to the stock market and seen all of the liquidity issues and short squeezes that have taken place over the last couple of years, this really makes sense to and hits home. So there's definitely a possibility where we basically get that situation where everybody wants out of dollars as the dollar is going up. So it creates a parabolic uptrend or a short squeeze that could take us easily past the 2001 peak, even past the 1985 peak. And that depends entirely on what happens with inflation and then what happens relative between the central banks. So if the US dollar and central banks are strong and have a high interest rate, the currency will stay strong relative to the others. So let's just say, for instance, hypothetically, the Federal Reserve was to stay really strong and continue raising rates all through 2023, but all the other central banks, let's say, Canada, Japan, Europe, England, all decided to pivot. All of their currencies would get substantially weaker compared to the dollar because the interest rate would be so much less. There would be a lot less demand for those currencies. Therefore, the demand would cycle into the dollar. And that is the scenario where we could essentially get a dollar short squeeze, where this thing just rips to the upside before eventually crashing and becoming worthless, as the system itself would basically fail. Because if all of a sudden there's a short squeeze on the whole world, anybody that has dollar denominated debt but doesn't have their currency in dollars or their income in dollars, they would suffer massively from this situation. So obviously it's a hypothetical situation. Anything can happen, but we see very clearly on this chart right here that what was clearly a downtrend on the DXY, the dollar relative to other currencies, has in fact flipped, and now it's in an uptrend. So we get into it very detailed, obviously there, super long-term outlook, but the potential scenario is that we do take out this previous swing high, and then at that point in time, we have to really start looking to key levels up here over or around like 160. So how does this work for investing, and how is this useful in the future? Well, the truth is, if you were looking to invest in countries around the world and you see the DXY is strengthening relative to all the other currencies in this basket, or you would tend to invest in dollar denominated assets, aka the American stock market or USA bonds, something along those lines. The problem with international investing is if you live in the United States and then you buy stuff in the United States, it makes no difference. If you live in the United States and then you invest in the UK and the UK stock market crashes, as the dollar strengthens, not only do you lose money on the UK stock market crashing, but you also lose when you convert back over from your UK denominated goods or assets into USD denominated goods or assets. So it can have a drastic effect on the yields. Or another example would be, let's say you live in the United States and you invested in UK. The UK stock market does okay, but the UK British pound drops substantially relative to the dollar. You might have done okay in the actual stock market, but again, when you go to convert back into dollars, you get substantially less dollars. So the gains you make on the stock market can easily be destroyed by the value that you lose in the actual currency exchange, or like Forex market. So very, very important, massive dynamic, whether you live in the United States or outside the United States. This is one of the most important charts that you could ever possibly look at. And over the next few months, few years, we're going to find out if this is going to put in a new high right here and then potentially one day threaten the all-time high, or if it has topped out, it's going to break back down here and then eventually put in a lower low. So that's it for today's video on the DXY dollar index deep dive. Remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. That's it for today, Crypto Trend Trader, and I'm out of here.